Welcome to a world where investing in dividend stocks is often seen as the golden ticket to financial freedom. But what if I told you that this common belief is misleading? Shocking as it may seem, nearly 75% of new investors think dividend stocks will make them rich quickly. In reality, only about 20% of Americans are financially literate enough to understand the true potential of these investments. Did you know that the average dividend yield in the S&P 500 is only around 1.8%? That's barely keeping pace with inflation. While many investors chase these payouts, they overlook the bigger picture. The truth is, relying solely on dividends can be a slow road to wealth, often filled with unexpected costs and missed opportunities. In this video, we'll dive deep into the world of dividend investing. You'll learn why high yields can be a trap, how taxes can bite into your earnings, and why focusing only on dividends might limit your overall growth. Get ready for some eye-opening insights that will change the way you think about investing in dividends. By the end, you'll have a clearer picture of smarter strategies to build real wealth. Let's jump in. Chapter 1. The Slow and Steady Myth. Why dividends aren't a shortcut. When people hear dividend stocks, they often think of easy, passive income. But the truth is, dividend investing is far from a get-rich-quick strategy. While dividends can provide steady returns, they won't make you a millionaire overnight. In fact, the average annual return for dividend stocks is around 7–9% over time, according to historical data from S&P 500 stocks. That's solid, but not game-changing in the short term. Many new investors misunderstand the slow pace of dividend growth. The real magic comes from long-term compounding, not quick profits. Warren Buffett famously said, "The stock market is designed to transfer money from the active to the patient. Dividends reward patience, not speed." If you're hoping for quick results, this strategy might disappoint you. Take Coca-Cola, a classic dividend stock. If you had invested $10,000 in the 1980s, you'd be sitting on a nice return today, but it took decades to reach that point. You can't expect to achieve massive gains overnight. Dividend stocks are like a slow cooking recipe. They take time to fully develop. What many don't realize is that a dividend yield of 2–3% per year won't significantly grow your wealth fast. It's the compounding of those dividends, year after year, that eventually adds up. This strategy is for those who are looking to build wealth over decades, not months. If you start with unrealistic expectations, you'll likely be disappointed. Chapter 2. The Dividend Trap. Why high yields are a red flag. High dividend yields can look incredibly tempting at first glance. After all, who wouldn't want a stock offering a 10% yield? But here's the catch. High yields can be a red flag. A dividend yield of 7% or more is often a sign of trouble, not opportunity. Companies in financial distress often raise their dividends to attract investors, but it's usually not sustainable. Look at what happened to companies like General Electric. Once a reliable dividend payer, its dividend yield spiked before the company cut it entirely in 2018. A high yield might seem like a gift, but it can also signal that the stock price is falling due to deeper issues within the company. Instead of chasing high yields, focus on companies with a strong track record of growing dividends consistently. Companies like Johnson & Johnson or Procter & Gamble have increased dividends for over 50 consecutive years. That kind of stability is much more valuable in the long run than a fleeting high yield. A study by Hartford Funds found that companies with consistently growing dividends outperformed non-dividend payers by 2.4% annually from 1972 to 2021. It's the steady, incremental increases that create lasting wealth, not the lure of a high yield that might collapse next quarter. Chapter 3. The Income Illusion. Dividends versus capital growth. One of the biggest misunderstandings in dividend investing is the trade-off between income and growth. Many investors believe that dividend stocks are the best way to build wealth because of the steady income they provide. However, focusing solely on dividends can limit your portfolio's growth potential. Growth stocks, like Amazon or Tesla, don't pay dividends but can offer massive capital appreciation. From 2010 to 2020, Amazon's stock price surged by over 1,600%. Compare that to AT&T, a well-known dividend stock, which grew just 40% in the same period. Capital growth stocks tend to outperform dividend stocks, especially during bull markets. In many cases, reinvesting your money into growth stocks, instead of relying on dividends, can yield higher returns over time. For instance, from 1926 to 2018, dividend-paying stocks in the S&P 500 returned an average of 9.7%, while non-dividend payers returned 12.2%, according to a report from Morningstar. That 2.5% difference may not sound like much, but over decades, it can lead to a significant gap in wealth. It's also important to remember that dividends are taxed as income. Depending on your tax bracket, you could lose 15–20% of your dividend income to taxes. Meanwhile, capital gains from growth stocks are only taxed when you sell them, allowing your money to grow tax-free in the meantime. If your goal is to maximize your wealth, don't rely solely on dividend stocks. While they offer steady income, capital growth stocks can provide larger returns over time, especially when you reinvest your profits. Balance is key. If you're finding this information valuable, don't forget to subscribe to the channel. Hit the notification bell so you won't miss our upcoming videos packed with more insights on smart investing strategies. Chapter 4. Taxman's Bite. Hidden costs of dividend income. Dividend income might seem like free money, but Uncle Sam always takes his share. One of the biggest hidden costs of dividends is the taxes you have to pay on them. Most people don't realize that dividend income is taxed differently than capital gains, and it can eat into your returns. For qualified dividends, the tax rate can range from 0% to 20%, depending on your income. But if your dividends aren't qualified, like those from REITs, real estate investment trusts, you could be taxed at ordinary income rates, which can be as high as 37%. That's a hefty chunk of your earnings. Let's put this into perspective. Imagine you receive $10,000 in dividends this year. If you're in the 22% tax bracket, you'll owe $2,200 in taxes, leaving you with $7,800. Compare that to capital gains, where you can defer taxes until you sell the stock, and suddenly, dividends don't seem quite as attractive. In his book The Little Book of Common Sense Investing, John Bogle points out that over time, taxes on dividends can reduce your overall return by about 2% per year. That may not sound like much, but over 20 or 30 years, it can add up to thousands of dollars. To minimize taxes, consider investing in tax-advantaged accounts like IRAs or 401ks. In these accounts, your dividend income can grow tax-free or tax-deferred, which makes a big difference in the long run. Another strategy is to focus on companies that pay lower yields but have higher growth potential, reducing your immediate tax burden while increasing your future wealth. Chapter 5. The Reinvestment Reality. How dividends delay wealth. Reinvesting dividends is often hailed as the secret to building wealth. And while there's truth to that, the process is slower than many realize. When you reinvest dividends, you're buying more shares, which helps your investment grow over time. But this strategy only works if you're playing the long game. The average dividend yield for the S&P 500 is around 1.8%. If you're reinvesting that, you're adding a small percentage to your overall returns each year. The real benefit of reinvesting dividends comes from compounding, but it takes decades to see significant results. Take Coca-Cola again as an example. If you bought $1,000 worth of shares in the 1990s and reinvested the dividends, by 2020, your investment would have grown to around $10,000. That's a nice return, but it took 30 years to get there. If you're expecting rapid growth, reinvesting dividends won't get you there quickly. In contrast, a growth stock like Amazon doesn't pay dividends, but if you had invested the same $1,000 in 1997, your investment would be worth over $1 million by now. That's the difference between income and growth. So, if your primary goal is wealth accumulation, reinvesting dividends might delay your progress compared to more aggressive strategies. It's crucial to balance reinvesting with a broader growth-focused investment strategy. You don't want to wait decades for returns when there are faster ways to grow your money. Thanks for joining us on this journey. If you enjoyed this video and found these insights helpful, please subscribe to the channel. Hit the notification bell so you can stay updated with all our latest videos on smart investing strategies and wealth building tips.